Hey everybody, I'm John VanDuzer, CPA and partner with James Warren Company. I'm here with Kyle Paxton, one of our exceptional tax managers. And today we're going to be talking about tax planning for Airbnbs. So I feel like in the last few years, Kyle, we've gotten a lot of questions on Airbnbs, and it's a really trendy investment right now. So really just want to talk about, hey, let's break down taxes for Airbnbs so you know a little bit more about it before jumping headlong into that kind of investment. So thank you for your time today.
Absolutely. Thanks for having me back. This is my part two of our video series. And if you haven't caught previous editions of this, it's super helpful. We have a lot of great CPAs involved in this real estate video series. So happy to be here, John. I appreciate you letting me join you. Airbnb, as you said, is certainly a hot topic. I myself have had plenty of questions on it. So got researched up and we're ready to go. And we're a great team to talk to in this space.
Yeah. So I think the very first thing on when you're approaching an Airbnb is really trying to drill in on what is the tax treatment of an Airbnb. And it's not always straightforward. So I figured the first place to start is why don't we run through what are the various options for the tax treatment and kind of what criteria will push you into that different types of treatment.
Yeah, that's a great way to cue it up. And I think we start with just looking at the income piece, right? And so if you hold an Airbnb in your name personally or within an LLC, by default, those are both going to be reported on your individual tax return. So there's no separate filing from a federal tax perspective, just reported on your Form 1040 with your W-2 wages, whatever else you have going on. So on the surface there, nothing super complicated. So then you start looking at the income and the characterization of the income, and really where on the form are you putting this, reporting this Airbnb income, right?
Right.
So there's a couple different buckets you get into. Just high level to start, if you have your personal residence and you live there for almost all the year and you rent out a room in your personal residence or the residence itself for less than 14 days, you don't have to report the income at all.
Right.
Easy, high level, no reporting issues there.
So the Super Bowl came to Tampa last year, and you rent out your house and go on vacation for the week. That income is non-taxable, right? It's the perfect loophole because it's an isolated event, and so as long as it's rented less than 14 days in a year, tax free. So that methodology would apply with Airbnb as well.
John, I love your example of the Super Bowl. That's great. There's a lot of places around the country where you have sporting events is huge, right? I've heard about this too in context of the Masters in Augusta, Georgia, where people in that space rent out their home for the weekend, make some nice money off of it because it's not cheap going to the Masters. But yeah, no reporting issues there, whether be it Airbnb or otherwise. So that's a high level. There's the no income reporting. And then, of course, with 99% of the things you do, you actually have to report the income. So generally, you are going to report income for rentals, whether it's, we'll talk about the Airbnb side, but rental income in general is reported on your Schedule E of Form 1040. And that's going to be the case with Airbnbs too, unless you are providing substantial services in that with also with the rental property. And that is more of kind of a bed and breakfast setup, right? So
Right.
if you're performing kind of the cleaning duties while your tenants are there, concierge type services, doing tours and things like that, that's where you're going to start breaching into that substantial services
Yeah.
section.
So you have to kind of take a step back and look and say, hey, does this Airbnb look real similar to a rental house, or does it look more like a hotel? And if it's a rental house, you're going to treat it as a rental on your tax return. And if it looks like more like a hotel, you're going to treat it like a hotel, which is a trade or business on your tax return. And there's some distinctions around that, but that's a real big thing to look at just to make sure that you're treating it correctly. And then what's kind of the other gotcha that we see a lot with places in desirable locations?
Sure. If you have that beach condo you're renting out as for an Airbnb for a good part of the year, but you also are using that for personal use for more than 14 days. So we had the 14-day limitation on the don't have to report income side, and now we have it on the more gotcha side where normally you get to deduct all of the expenses related to your rental, whether that's, again, Airbnb otherwise, on that Schedule E or Schedule C, depending on where it falls. If you're using that property personally, and that includes family members, things like that, if you're using that for personal use for more than 14 days out of the year, those expenses start getting hit with limitations, and you start adding complexities there, and certainly the deductibility of the expenses are impacted based on the percentage of time you're using that property personally versus when you're renting it out with Airbnb.
Right. So to summarize in the tax treatment, there's kind of 3 or 4 different buckets, right? One is you rent it very infrequently, have less than 14 days of rental period throughout the year, and you use it as a residence, right? And that's tax free. If you use it more than 14 days throughout the year, you got to layer on these vacation limitation rules, which get somewhat complex. And then if you don't use it personally and you rent it out frequently, you really have to look and say, hey, do I look more like a rental property or do I look more like a hotel? You know, and that's kind of that initial classification or initial assessment you have to make in order to start trying to figure out how to treat it correctly on your tax return. Moving on to expenses, which I think is really important, is how do you track all these deductions? You know, and the tax code when it comes to expenses is somewhat vague. There's a code section 162, and it basically just says, hey, if the expense is ordinary and necessary, you can deduct it, right? And then there's a whole lot of court cases to help define what ordinary and necessary means. So what are some best practices when it comes to expenses for an Airbnb or a similar type of investment?
Yeah, that's a great question. And broadly, anything that's connected to the activity, whether we're treating it as a business on the Schedule C, more of your hotel bed and breakfast type treatment, or as a rental property, you know, from an expense standpoint, it's treated the same way. So anything that's connected to that activity, the obvious ones, right, are property taxes, utilities, things like that, of actually maintaining the property you're renting out. But you know, that can be stretched out into anything it takes. If you're having to visit this property a lot throughout the year to maintain it, you start getting into vehicle mileage. I mean, the list goes on and on, John, of the things you can deduct. And that's a big area to look at. And really, when in these kind of outside of just making sure you're reporting everything properly and more on the compliance side, kind of digging into these things is really where our value add starts coming and
Right.
trying to help people identify those expenses, and then certainly maintaining it all, right? So having a good system to track all of your expenses and trying to draw a clear line in the sand between the expenses on the property you're renting out versus your, you know, if it's connected to your personal residence, or you start getting into that gray area bucket of business versus personal type, really drawing a line in the sand between those things and coming up with a good method for what works for you, and keeping those separate and coming up with a good tracking system is hugely important.
Yeah. And I think the other side of this is documentation, right? Like we get the question periodically, well, how much can I deduct? And it's like, well, the question's being framed a little off, because it's not how much to deduct, right? It's how much did you spend? And so if there's ever an IRS audit, the first thing they do is ask for receipts and invoices and substantiation for those expenses. And so what we always tell our clients is you need to keep good documentation, right? If you're going to deduct mileage, you should be keeping a mileage log. If you're going to deduct repairs, you should have invoices for those. Like it's really important to have documentation, because in order to sustain an audit, that's what they're going to be looking for, and that's really what you should be able to provide. But you know, as long as you have that box checked, as long as it's connected to your business, again, ordinary and necessary, it's a reasonable expense to deduct. So one of the more mystifying expenses that we get to take on a tax return is depreciation, right? And that's something that I think, you know, typically accountants will calculate that because it gets complicated. But maybe we could just run through real quick depreciation. You know, first off, when we talked about the tax treatment, you know, it can be different depending on where that tax treatment lands, right? So tax treatment for a rental property or the hotel type classification, it can be 2 different things. But what are some other areas within depreciation that you really have to look at and make sure you pay a lot of attention to?
Well, John, to start, you're signing up to be doing this video for about 3 days, because that's how long it'll take me to comprehensively walk through depreciation. It's from, especially in the depreciation realm and on a broad scale, in the tax realm, it's a great time to own real estate, right? And there's a lot of really beneficial depreciation rules out there right now that make owning Airbnb, a rental property otherwise, residential, commercial, whatever bucket you fall into, really beneficial, and you can start kind of recovering some of your investment through tax savings. So John alluded to how the tax treatment of income, which we discussed before, drives the depreciation piece a little bit. So if our Airbnb, if we're providing substantial services to our tenants, then we're starting to creep into that the Airbnb, or I'm sorry, bed and breakfast hotel type of situation where we're running a business here, right? And so that sort of pivots your property to depreciating the building portion of your Airbnb over 39 years, where traditional residential rentals, and if you fall into the more the rental without substantial services treatment for the Airbnb, you're looking at depreciating over 27 and a half years, and that's just for the building piece.
So that's the beauty of our tax laws. You have the exact same property depreciated 2 different ways depending on how you use it.
We like to complicate things, don't we?
Yeah.
Yeah, and so then within that shell, right? So we're depreciating the building over 27 and a half, 39 years. Generally, when you acquire a property, you want to pull out the land component, which you're not going to depreciate. There's no depreciation deduction for land as a whole in the tax code, period. Then we start looking at the components inside. And that's where we can really start getting some of these advantageous depreciation deductions. And it can look a little differently based on the tax treatment of income. But John, we can start first talking about the difference between how do you actually determine what you depreciate, right? And so,
so anytime you make an improvement, right, the first determination you have to make is, did I make a capital item, right? Something I have to capitalize and depreciate, or is this a repair? And so a few years ago, the IRS put out regulations and pretty much said, okay, we're going to say RABI, R-A-B-I, restoration, adaptation, betterment, or improvement. And if it's one of these 4 things, it's a capital item. If it's not, it's a repair, right? And so when we look at different items that are done, say painting, for instance, painting is a repair. So if you paint the whole building and it costs $10,000, you can expense that as a repair. A roof is a building system and is more of a capital item. If you replace the whole roof and you spend $10,000 and replace the whole roof, that's a capital item and you depreciate it, right? So again, you're spending the same amount of money, but the treatment is different depending on what you spend it on.
Sure.
What's one other area that you can really accelerate some depreciation when you're putting in specific kinds of property?
Yeah, sure. So this is big for me, right? So next month we're getting into summer, and I want to stay cool. Next month I'm going to the Keys, and one of our criteria we looked at with Airbnbs is I want a swimming pool, and so that in itself is a capital item. It's not cheap. You spend a whole bunch of money on it, and you're improving the property significantly, correct? So generally under the tax law, you're going to capitalize that, and you get a depreciation reduction over 15 years for that land improvement. Good news is right now for land improvements, you can take bonus depreciation, and that is a provision that allows you to take 100% of the cost as a tax deduction in year 1. And depending on what tax bracket you're falling into on your individual return, that can be a huge cost recovery up to over 30% of your investment. And that's huge.
Right. Yeah. So you take and so bonus depreciation is anything that's 5, 7, or 15 years. So a lot of your furniture, fixtures, and land improvements, which a swimming pool is a great example, where you can accelerate that deduction and take that full deduction in year 1. So that's a huge benefit if you were making those type of improvements. But then the last kind of area we want to talk about is what's called the passive loss rules, and these were put in back in the 80s whenever the people would buy real estate as a tax shelter. And so this will kind of help negate maybe some of that benefit, possibly, unless you meet certain exceptions. So when you're looking at the passive loss rules, where do you start on really determining, hey, can I even benefit from this loss that I've generated from this swimming pool that I put in?
There's too many places to start, John. This is one of the areas that's overly complicated, and we can look at this from a handful of different angles. But on the surface, the first question you want to ask, especially when you're looking at the substantial services type of operation, is, are you materially participating in this activity? And we're throwing around a couple of terms here where there's material participation, active participation. There's a million different participations that all mean different things. So keeping that straight can be cumbersome and confusing. But high level, you make a determination on how actively you are I'm trying not to use the term, and I'm using the term, how active you are in this enterprise, right? And so when you're doing the bed and breakfast type of Airbnb, if you're providing substantial services and you're doing that yourself, you're materially participating in that business, right? You're really hands-on, you're spending a lot of hours, and we get back to kind of documenting all of this, but the benefit of that is then you get pulled out of the passive loss rules, which generally are going to limit any losses you're incurring. And if you're accumulating losses in an enterprise that you're materially participating in, you aren't subject to those limitations, and you can offset other non-passive income with income from this real estate activity.
Right. And so for material participation, again, like Kyle said, it's a very specific term. There are 7 tests for material participation. You have to pass one of those tests, but allows you to take those losses and offset it against other non-passive and passive income that you would have from other sources. Now, if it's classified as a rental property, right? So if we're in the rental realm, they kind of layered in this presumed passive treatment on a rental. So you can only really benefit from that if you go and pass the real estate professional test, which we've covered in a few of our other previous videos. So that's our quick snapshot on Airbnbs. There's a whole lot of complexity, but I think overall, you know, there are some favorable treatments. It really becomes a record-keeping exercise to make sure that you can fit in all these boxes, but there definitely is some favorable tax treatments around that. So thank you so much, Kyle, for joining us, and we look forward to the next video.
Thank you, John.
To learn more about James Moore & Company's real estate accounting and business solutions, go to JMCo.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.